The Conference Board of Canada has published a new article highlighting the true cost of Trump tariffs. As Canada braces for Trump's proposed 25% tariffs, what do they really mean for Canadian businesses and for consumers? And is there a path to resolution here? I'm happy to say that we are joined here by Pedro Antunes. He is Chief Economist at the Conference Board of Canada to explore the board's findings and unpack what they might mean for Canada's economic future. A warm welcome to you, Pedro. Thank you for joining us here.
Well, it's a pleasure. Thanks for having me, Pamela.
Yeah, delighted to go through some of your findings and the report itself. I wonder if I might ask you to begin with, there are some, dark shadows over the Canadian economy, lots of uncertainty. That said, there are some bright lights that may not be affected by the tariff story. I wonder if we can just begin there. What do you see as being maybe a safe harbor?
Well, it's not, I think it's in some ways very self-evident. And the point I'd like to make, and I like to encourage people to think about, is that Canada is not really a manufacturing economy anymore. We're very threatened by these tariffs on the manufacturing side of the economy and certainly on the resource side as well. And I know we're going to get into some of that, but where we have had success is on the knowledge side of the economy. These are professional, scientific, technical service jobs. And here I'm talking private sector, where we've done extremely well, especially since 2015 and through the pandemic. We've seen phenomenal growth in that segment. In fact, growth in employment in professional, scientific, technical services has outpaced private sector employment 4-to-1, 4% growth a year versus 1% growth in the rest of the private sector. We've had success at exporting these services. These are essentially service sector exports, and they're barely mentioned or noticed by the Trump administration. It's very, very focused on the good side of the economy, of trade, that balance, or how should I say, that trade deficit that President Trump keeps alluding to is excluding the services. And I think this is where Canada has done remarkably well. We've seen very strong growth in services sector exports, and these are things like financial services or engineering services or software development, these kinds of things. The other piece of good news is that we've had for a long time lagging productivity in Canada. And if we focus on this segment of the economy, this is where I think adopting technologies like AI, cloud-based technologies will help us kind of accelerate productivity in these segments. So I'm very hopeful, at least with respect to these pieces for the future, even as we see this kind of looming, how should I say, crisis on the horizon with our relationship with the U.S.
So let's go into, so that sounds like many areas actually, that we can focus on. And then what else can we do to sort of get our economy ready? I'm thinking of the interprovincial trade that looks like it is going to finally make some room for trade across provinces. That's one things to get ready for. Maybe there's a tax side of things. Tell us a little bit about how we can get ready in Canada for this. I mean, even if they aren't imposed.
Well, I got to say, Pamela, you're perhaps a little more positive about success on that front than I might be. Maybe because I've lived through it for such a long time. We've been talking about interprovincial trade barriers. We've been talking about diversifying trade for a long time at the conference board, and myself involved in some of those research projects. And we've not seen a lot of success. And shame on us, really, for not taking more action on these things earlier, especially on interprovincial trade. So now we're kind of pushed into a wall, and we have challenges with trade south of the border, our biggest trade partner, and we're finally looking inward and saying, oh my gosh, why haven't we done more about opening up essentially a common market within Canada that would allow for competition, that would allow for specific firms or certain firms to get bigger and more productive and more competitive on not only within Canada but on a global stage. It's just it would have been something we should have addressed a long time ago. But maybe this is another piece of good news, if you like to take it that way. We're finally seeing a resurgence of this issue, and the way that are what we call non-tariff barriers. The way these things work are essentially they're regulatory requirements that each province might have on essentially trucking, transportation, on any slew of how should I say, of regulations around products or services, or around qualifications of workers. And so what we're talking about now, or what is the potential quick solution, is again something we've been talking about for a long time. Australia adopted this many years ago, and that is mutual recognition. And that is to say that, okay, well, if a certain standard in, for example, truck transportation, weights, et cetera, if a certain standard is good enough in one province, then that'll be good enough for other provinces. We don't necessarily have to go back to the drawing board and realign all the regulations. So there's hope. I do think we'll probably see some gains being made in some areas, in some industries. I'm hopeful that we will tackle the issue of mobility of labor to recognize credentials and across very many different occupations. And in fact, we have mutual recognition agreements internationally with some countries. This is why South Korea is able to bring in workers to build a battery plant in Windsor, for example. So let's hope that we can do more on that front. There's other issues, of course. We're talking about retaliatory tariffs on Kentucky bourbon, for example. But we also need to open up essentially the ability of Canadian consumers to buy essentially products from across Canada. So there's a lot of things that we can do there.
What about are you looking at taxes? I mean, we keep hearing about companies in Canada thinking if their next big investment in a plant or whatever it might be, it's just a cheaper corporate tax rate in the US, has been for a long time. Is that something that's something within our power to do? It doesn't mean it wouldn't hurt, but is that on the board?
Yeah, it's such a challenge. First of all, let me say that I think part of the strategy here from the Trump administration is a repeat of what we saw in 2016. And that is in 2016, it was the threat of dissolving NAFTA. NAFTA was a devil, and the threat of dissolving NAFTA was enough to scare companies about, will I have access once we renegotiate whatever this trade agreement that is coming, this new trade agreement, will I have access from a Canadian perspective to the US consumer? And if there's uncertainty about that, then that moves investment south of the border. And I think that was the objective. And I think it had a lot of impact on doing just that, a success, if you'd like. It's a bullying tactic. It's, just the worst diplomacy, but it works in terms of moving investment. And I think we're seeing with these tariffs now, certainly a sense of a repeat, a deja vu of what happened back in 2016. So
just the threat of them.
Just the threat of these tariffs, I think, is enough to move investment, and I think that's the objective, really. At least I'm hopeful that it's not the madness of broad-based tariffs, but we can talk about that in a minute. So the challenge really is attracting private investment into Canada. And when I say private investment, I'm talking about essentially building or investing in machinery and equipment or physical structures that drives essentially our productive capacity and our productivity. And we've been lagging the US, and in fact, we've been lagging many other European countries as well on that level of investment. So of course, this is a challenging environment. What is the other challenge? It's what you allude to. It's the taxes. And if you look at the posted tax rates, they're not that different between Canada and the US. It's more around the total corporate tax paid because of the massive amounts of subsidies that US states and the US federal government through the IRA and other programs is, and along with the tax cuts that we saw back in late 2017 that President Trump implemented. So all of these things have meant that Canadian firms are paying a lot more corporate tax overall than the US when we look at the bottom line numbers on that. Can we do something about it? Well, I'd love to say yes. I mean, we can review some of the tax programs that we have. I think we're due for tax reform. We're long overdue to look at our competitiveness in the tax regime, not just corporate, but corporate and in fact, personal income taxes. We had a first budget in years well, it wasn't a budget. It was the fall economic statement, as you might remember, with all the controversy around that. But it was the first time we'd seen anything that addressed some of the tax competitiveness in a budget in many, many years. We need to do more on that front. Now, that budget just extended essentially capital depreciation allowance, and it talked about a patent box that we might see in the 2025 budget. So we can do some things. But the underlying problem really, Pamela, here is that the US is essentially running a deficit that's according to Congressional Budget Office, that's the kind of the federal watcher in the States, a deficit of 6.2% of GDP with a debt load that's going to hit 100% of GDP this year. In Canada, we're running deficits of 1% of GDP. Do we really want to subsidize firms to the point where we end up with these kinds of deficits? Can we afford to raise taxes elsewhere? You know, it's just a real challenge because we don't want to be in that situation. And I think, if I could add, this is a real challenge for the Trump presidency because essentially in 2016, we were able to do the tax cuts without tax measures. This time around, you know, of course, they're trying to cut government spending, but that's not going to be enough. And this is partly why I think
talking about DOGE, are you? Is that
yes, this is partly the tariffs that are coming in to fill some of that problem that the administration is facing.
So, I mean, to what extent do they, in your opinion, need the tariffs for the revenue? I mean, this is sort of a well-known spoken word that tariffs are really important for revenue, but is that really the case? Like, will that stick?
No. I think it's just such nonsense. I mean, tariffs are, you know, essentially they're called import tariffs for a reason, and that is the importer pays the tariff. So if we're, you know, and again, it'll depend on, and it will have an inflationary impact on the U.S. economy, and it will slow economic activity. I mean, there's no doubt it will hurt their competitiveness. So yes, in the short run, you may see some products that, you know, essentially firms will be unable to find other suppliers, will be unable to move. They'll certainly not be able to move production quickly back to the US. When you think about aluminum or steel, we had aluminum and steel tariffs imposed in the last administration from President Trump. By the way, there's evidence that did not increase production in the U.S. of steel or aluminum. They just paid a higher price for it. Same with softwood lumber. There's plenty of evidence that we've had ongoing tariffs on Canadian softwood lumber exports to the U.S. And, you know, time and time again, we've seen that who pays for that? Well, it's the U.S. consumer. Now, the government may reap some benefit of that, but if you, at the same time, are taking away from consumers' ability to purchase, that slows economic activity and that hurts your revenues in other ways. So this is just, there's an old quote. It's called Murphy's Law of Economics. It's, you know, this is from a professor of economics in the States that talked about this years and years ago. And Murphy's Law of Economics, it basically says that where economists are most aligned on a policy, that is that free trade is a win-win. There's always, you know, policymakers don't adopt those policies. And in fact, it's where the economists are least aligned that a policymaker will choose that policy. In other words, at the time, Professor Blinder, who was the one that came up with Murphy's Law of Economics, at the time it was about Reagan tax cuts way back then. This time around, it's about these tariff wars and the idea that tariffs will bring back this glorious state of U.S. economic growth, when in fact they'll do just the opposite.
Short term, as you say, but the impact. Let's go into the manufacturing, the goods side of the equation. So you mentioned off the top that actually, if we focus more on services, that will probably be beneficial because that's not so much the concern of the Trump administration. However, manufacturing is very much what Ontario is built, and many provinces across the country are built on. I mean, is that really going to go away? How serious is this?
Well, this is where, I mean, I personally feel that it doesn't make any sense at all for both sides of the border. And I think, you know, essentially a broad-based tariff on manufacturing is an attempt to, how should I say, to disentangle what we've built since 1994, since we've had this free trade agreement with the US, which is an amazingly integrated production, supply chain production on autos and on all other really manufactured products, including, by the way, Mexico, which is a big part of that, tied in supply chain, with Mexico typically addressing more of the labor-intensive needs on the manufacturing side. So to try and disentangle this with tariffs is just going to essentially destroy the industry on both sides of the border, I think, over time. And it to me, of course, the bigger impact will be immediately on Canada and on Mexico. 25% tariff on manufactured goods, and as we know, those products traverse the border with the value added of each of the the contributing nations. They traverse the border many, many times, and that means the tariffs would be applied at each stage that it goes from Canada to the US, or from Mexico to the US. You can imagine that the products then would be non-competitive. I mean, it would add a lot to US consumers' prices for those products. It would render those products uncompetitive globally. It's just a bad idea. So, I mean, I think, again, the threat of these tariffs is really, I mean, there will be some tariffs applied. I mean, we've seen them in the past. I think we may again see tariffs on steel and aluminum. I mean, we're already hearing about that. But, to see tariffs applied across the board on manufacturing or on the auto sector, I can't imagine that this would be a policy that would be adopted. And
Okay.
if I
Okay,
might
go
add
ahead.
just one thing, I think what will keep President Trump in check, and one of the things that he is dependent on, is essentially equity markets. And I think equity markets would react very badly, and we've seen a glimpse of that just
Yeah,
a
we've
couple
seen
of
it.
weeks ago.
Mhm.
So I think that's what will keep sanity here in terms of some of these policies.
Certain stocks in particular,
Yeah.
sort of what's gonna happen on the auto front of things. Let's go to commodities. Commodities are bought and sold, with a global standard, with a global, price in most cases. We keep hearing, though, that there's going to be sort of a realignment on that, and we're watching a little bit of what's going on with Ukraine, which is not analogous to trading partners, but it is this sort of deal of commodities, rare earths for defense spending, and you just wonder a little bit. What do you see on the commodity front? Maybe it's a broader view of commodities across this country.
Well, I mean, I go back to some of the statements made. I mean, first of all, that the idea of a trade deficit with Canada that the U.S. has, that this is somehow a subsidy. Well, that's absolutely not true. What it is that the U.S. is purchasing our products, as you mentioned, Pamela, that products and resources, mostly, most of our trade with the U.S. is resources. And these products are sold at a global price. There's a global market for these commodities, and they're sold into the U.S. market as inputs, as important inputs into their production process. The other fallacy that we've heard is that they don't need these products. Well, that's absolutely not true as well. In fact, the U.S. is a big importer of oil, and U.S. refineries are tuned to using heavy oil from Canada, which they can get. Well, they can get from Venezuela, but nowhere else. Essentially, they wouldn't be able to supply those refineries without Alberta heavy oil. And the list goes on and on. I mean, potash, a lot of the agri-food products, the oil seeds, et cetera, that we produce, not to mention minerals and rare earth minerals that we produce that are necessary inputs. Now, there's a case, in some cases, there is a case to be made if there's a critical mineral or a critical input that the U.S. feels is, it's a security issue, then certainly, I think even within the WTO, there are rules in place to allow for tariffs to protect those industries in the domestic market. But I think this, again, these kind of ideas that we're going to be seeing broad-based tariffs on resources, that's just a bad idea for the U.S., really. In the long run, it will hurt the U.S., I think, more than it would hurt Canada. We would find other markets for these products with difficulty, and some with a lot of difficulty. I keep thinking about heavy oil. We've got pipelines that head south. We have a new pipeline that allows us to get some oil from Alberta to Tidewater, but it's a very little portion of our production. So yes, I mean, it would be very hurtful to start to both parties. But on the long run, I think we would find solutions to get our products to market.
Perhaps going back to the interprovincial discussion, pipelines going across provinces might fit into that. discussion. It's not been at all easy to make that happen. In fact, many have been thought up as thought projects and canceled before they got anywhere close. What do you think now, though, prospects for pipelines across provinces?
Yeah, well, that's a really good point, Pamela. We talked about interprovincial trade barriers or non-tariff barriers, is what I like to call them, early on. But essentially, some of the other challenges have really been around physical infrastructure, transportation infrastructure to get products across our country rather than just north-south. Now, you can't really blame. We've got a market south of our border, which is a quarter of the global economy. It's a U.S. consumer. Certainly in years prior to China's ascension, has been responsible for about 15% of global consumption. So, obviously that's an important market for us, and we did, I think, the smart thing is take advantage of our trade relationship. But we didn't really. We also, had impediments to essentially infrastructure that would allow us to do more interprovincially. And I think just a few years ago we were contemplating the Energy East pipeline, which was essentially meant to bring Alberta oil to refineries in central Canada and Quebec, and that was declined, or even out east, in fact. And that was, essentially ixnayed. We were not able to get that pulled across for all the political reasons behind it. And unfortunately, we have Line 5, so we're very dependent on that pipeline, which the U.S. has already threatened to cut, which brings essentially that oil into refineries into Canada. So we're, again, very, very dependent. It's a really difficult situation with respect to, not having put these things, how should I say, these other pieces of critical infrastructure in place to allow us to trade better within our own economy.
Regardless of who runs the country from Ottawa, and we don't know who that's going to be over the next, it'll be decided maybe in the next 6 months or so. Are we going to have a building boom of infrastructure?
Oh, goodness. Well, you may be surprised driving on our roads and feeling the bumps everywhere, that in fact we are seeing public spending on infrastructure at fairly high levels.
Yeah.
They're running at about 4% of GDP, which is not low. I mean, there was a long period of time, especially you may recall when we were talking about infrastructure gaps. This is mostly municipal infrastructure. I think that we had challenges there. I would like to say that. Yes, I mean, certainly we could talk about pipelines east now. I don't know if it's too late for that. We may talk about essentially more bridges, more roads. But one of the big challenges right now is a little bit unrelated. It has more to do with congestion in major cities. And one of the bigger contributors to our productivity decline that we've seen over the last couple of years that everybody is waving their arms about has been because of transportation in general. Productivity in transportation has declined. And there's two pieces that are tied within that. One is that public transit productivity is way down. And that's because people are not using public transit, even as we are returning to work in person more and more.
But you
We're
don't
just
know if
not
it's going
using
to
it.
work. You don't know if it's going to be canceled.
Well, there's that issue for sure, for sure. But in general, we're well below where we were prior to pandemic. And that's causing a lot of congestion in cities, which is affecting our productivity in truck transportation, which is another component in that subsector, which is having. So I would like to see more focus on essentially promoting public transit, perhaps investing to improve the systems and the problems that we've had in some areas. I live here near the city of Ottawa, and obviously we've had a number of issues with our own systems here. But yeah, and personally, if we're looking to promote greening the economy, I think more use of public transit, less people on roads, whether they be in electric vehicles or in gas vehicles, I think would be helpful to that end as well.
That's actually a really hopeful couple of pieces to focus on to finish out. Is there a final message that you'd like to leave everyone with today?
Well, I've been wrong in the past on the politics. I do my best here, and I try to understand what drives the policy decisions south of the border, and I would just reflect and think about again, what happened back in the first time that President Trump was in power, that we saw all of these threats around dissolving NAFTA, for example. And again, I go back to the intent of that, which was really, I think, to move investment without really doing anything. Because once we renegotiated NAFTA and we've essentially landed on CUSMA, it is in fact very much the same deal. And President Trump at the time said it was the best deal ever. We may hear differently in 2026 when it's time to renegotiate that again. But essentially, in the end, there wasn't really these dramatic measures put in place. We didn't dissolve our free trade agreement, but it did have the success intended, which was to create that uncertainty and move investment. So I would hope that what we're seeing again this time around is that similar pattern. This time around, it's more around threats of tariffs that are causing this anxiety. Certainly, we're jumping at every time we get an announcement on something, a new tariff that's coming. Let's just take a breath and let's wait and see what the policies are, and then we'll deal with what we can at the time. But hopefully, again, this is more threat. This is more to create that anxiety to move the investment decision without really imposing these kinds of very hurtful, damaging to the economy kind of tariffs, to both economies, Canada, the US, and in fact, the world economy. So that's the hopeful message I have. And
okay, good. I like that. Let's leave it on that and stick with the hope. Pedro Antunes, the Conference Board of Canada, very grateful for you joining us here a little bit last minute, but thank you for your time.
It's been a real pleasure, Pamela. Nice talking to you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.